Hello everyone. In today's video, I'm going to discuss individual retirement accounts or IRAs, as well as inherited IRAs, beneficiaries of different account types, and some estate planning items to consider. We're going to start with some nuances when inheriting the assets of an IRA. Now, the different options that you're going to have when inheriting are going to depend on the relationship of the beneficiary to the IRA owner. It's also going to depend on whether or not the IRA was funded with pre-tax or after-tax money, and whether the account owner had crossed the threshold where they were required to take minimum distributions or not. Now, generally, when a beneficiary inherits the assets in a qualified retirement plan, like an IRA, or a trust, or they receive proceeds of a life insurance policy, this happens outside of a will. So it's very important to have your beneficiary set up properly and that you review this frequently, since life happens and things change. People often forget, or they didn't even know, that beneficiary designations for retirement accounts take precedence over a will or estate documents. This means that if you ever get a divorce and then you update your will or your estate documents, but you forget to update your beneficiaries, well, there's going to be some big problems if, God forbid, you pass away. So never forget to update your beneficiaries. Now, you can designate one or more relatives, non-relatives, or a charity or trust as beneficiary. And if no beneficiary is named, the account is going to be part of the owner's estate, and therefore it's going to be subject to probate. And if you can, you want to try to avoid probate because it is a time-consuming and very expensive process. All right, important side note. Other accounts, like bank and taxable investment accounts, are generally going to pass to beneficiaries through a will, but they must go through probate. But you can typically avoid probate if you have designated PODs or TODs. And what do I mean by that? Well, a POD is a beneficiary named as payable on death for a bank and or a credit union, and a TOD means transfer on death, and those are for accounts that hold stocks, bonds, and or any other taxable brokerage accounts. Now, back to IRAs. Generally, when an IRA owner dies, the IRA assets are going to be transferred to a new inherited IRA in the name of the original IRA owner for the benefit of the beneficiary. Now, that beneficiary cannot make contributions or roll the money out of the inherited IRA. The tax treatment of the inherited IRA is going to depend on whether it was funded with pre-tax money, as it would have been in a traditional IRA, or if it was funded with after-tax money, as it would be in a Roth IRA. Now, if the original IRA was funded with pre-tax money, the heir will have to pay ordinary 7-bracket income taxes in the year the money is withdrawn from the inherited IRA. So, if your heir is still working, this money is going to be added to their income and taxed accordingly. And if the original IRA was funded with after-tax money, well, then it's going to be in a Roth IRA, and the heir will not have to pay any income tax whenever they take out withdrawals from that. So obviously another huge benefit of Roth IRAs. Now, under the Secure Act, effective in 2020, inherited IRA assets have to be paid out to most beneficiaries within 10 years. And this is very unfortunate and disappointing because it's basically another shadow tax on the middle and upper middle income class. Before the Secure Act, required distributions could be stretched out over the beneficiary's remaining life expectancy, allowing distributions to be kept relatively low, and therefore taxes to be kept lower and way more manageable. However, the Secure Act eliminated this stretch IRA, so if your children are the beneficiaries, as is pretty common, this is going to lead to a high probability that they're going to have to take their distributions during what are typically their peak earning years, and these distributions are now going to be stacked on top of their peak earning years, so now they will likely have to pay very high tax rates on legacy assets. And as for inherited Roth IRA, they must also be withdrawn within 10 years, but since they are tax-free, they're not going to increase the beneficiary's tax liabilities. And of course, this alone makes another good, strong argument for Roth conversions as a key for legacy planning, not to mention using Roth conversions to limit your own lifetime tax liabilities. Now, as I've mentioned previously, I definitely believe that we are in the golden age of Roth IRA conversions, since our tax rates are as low as they've been in 100 years and are unlikely to go lower from here. And when do we want to pay taxes? Well, we want to pay them when they are the cheapest or the lowest, right? So bottom line, As you can see, there are a few very important considerations to make when considering the legacy of your IRA or any retirement plan asset. You need to pay close attention to your designated beneficiaries to make sure that your money is going where you want it to go, and pay close attention to how and when your heirs might receive assets, because it can have a large implication on your estate tax liabilities and their lifetime tax liabilities as a whole. And of course, you will want to discuss your specific situation with an estate planning attorney to make sure that your estate is set up properly to limit lifetime tax liabilities and have your money go where you want it to go. Thank you, and I will see you soon. Once again, Tim Dorman here, founder of Eagle Ridge Wealth Advisors. And if you would like to see how we help our clients get the most out of their financial lives in retirement, please visit us at erwealth.com, and we hope to see you there.